Well, it is fantastic. Thank you for coming. It's great to see you. And we appreciate you taking the time, have a little bit of lunch, and we get a chance to gather, which is wonderful. It's great to be in a gathering where we can actually see you. It's much better than a Zoom call, so it's great to be with you today. Okay, so today we are talking about the post-pandemic perspective when it comes to home ownership. And so the first question I have for you today that I'd like to pose to you is, what are your concerns? Why did you come, and what are your concerns? What are some of the things that you're been confronted with or that you're thinking about right now based on the last, 2 months? Now, here's the interesting thing about it, is that when the pandemic started, it just went boom, right? And have you noticed that when the rates went up and the market just went, right? It seems to be in that order. It seems to be happening that more and more. So tell me a little bit about what your concerns are. Terry.
How to get buyers to get off the fence.
Okay, so motivate buyers.
Seeing new properties that come online.
Okay. All right, good. That's excellent. All right, what else?
What's going to happen?
I feel like people are on the fence right now, and they're like, should we wait?
Okay, should we wait? And why do you think they're on the fence right now?
They think things are going to change.
Okay, so they think that the prices are going to go down, right?
They don't know.
Okay.
Oh, they're hoping it'll go down.
Okay, so they're thinking about, will prices go down?
Rates.
Okay, and will rates go down? Okay, these are big deals. Big deals. For every point that the rate goes up, there's 500,000 less people that qualify to buy. It's a huge thing. I mean, interest rates dictate everything that we do. I mean, whether you like to think about it or not, rates dictate getting up in the morning, our daily activities, cards we use, decisions we make. The cost of money is a big deal. And being able to qualify for that is even a bigger deal, right? Okay, what else? Those are good. These are good. Rates, what else?
People think that we're in a recession, the market's gonna crash, and it's
Okay.
gonna be another 2008.
Okay. Why do you think they think that?
If you watch the news.
Okay, what's the news saying?
We're in a pandemic. I mean, we're in a recession.
We're in a recession. Okay, so just because we're in a recession, does that automatically translate into a crash in housing? No. But people think that, though, right? Okay, that's the perception. Why is that not the case?
Because there is a demand for housing, and people have to live somewhere regardless of any economic circumstance.
Okay, good point. Good, Eddie. I'm glad you came. That's good. Okay.
Inventory for only 3 months right now.
What's that?
Only 3-month inventory in the market right now.
Okay.
Everybody has equity in their homes. It's not possible. It's not the same market.
Okay. All right. Okay, good. All right. Greg, do you have anything to say? Greg always has something to say sooner or later. It's great to see
A
you.
little bit of everything that everybody's saying. But I think a lot of people are afraid because they're watching the news and there's just this negative aura of all these things happening. One thing that I learned from my manager about a week ago, trying to talk people off the ledge a little bit, everybody is thinking about what happened 6 months ago. Rates were in the threes, rates are almost doubling, and they're married to the price. So what Joanne was saying in my office, she said, talk with your buyers and explain to them to write a competitive offer and write a little over the asking price and try to get a credit towards your closing costs so you can buy down your rate. And then you can try to put it into perspective that you can get the cost down.
Right.
So I think there's some creative workarounds
Oh, you bet.
to try to let these buyers know, look, everything you see on the news, don't get scared. Make this a long-term investment, and let's talk about how we can be creative to get you into a payment that you can afford.
Right. Okay, excellent. Okay, good point. All right, very good. All right, so let's go ahead and launch into this, and we'll talk about these as we go along today. All right. And in fact, let's just take this off. Okay, so we'll put this up here. All right. Okay, so let's go ahead and jump into this. Okay, so today's purpose. We want to arm you with information to better connect with your clients to help them navigate through uncertainty. It's the number one priority. If you can do that and give them the knowledge that they need, they'll be a lot more confident in you, and you will be the quarterback. We want you to be the quarterback, calling the plays, helping them through and navigating the process. Number two is we want to create 4 to 5 new deals that you would not normally have as a result of our discussion today, giving you some ideas, some things that may be of help to you. I want lots of feedback. I want lots of comments. I want to know where you're at and what your comments are. And I just put some ink on my shirt there. Okay, so let's keep going here. All right, so today what we're going to be talking about is we're going to address prices. Are they going to plunge? We're going to talk about redefining homeownership post-pandemic. This is a very big deal. Tools and strategies to increase your sales, and case studies if we have time. I'm not sure if we're going to really get to that because we're really going to spend some time on the recession and pricing plunge. So the first question is, will prices plunge? Navigating through uncertainty, economic uncertainty, and then the current mortgage lending. So let's go through that for just a little bit. Okay, so what we have here is we have a demand curve. And a demand curve is what economists use to be able to predict and model demand and supply and what prices will be based on certain commodities. In this case, this is housing. So this is the supply curve, this is the demand curve, and what you have here is you have price on this axis and you have quantity on this axis. This is considered equilibrium when demand equals supply, right? Now, when we get into a situation where demand becomes greater than supply, what happens is, in this particular case, we'll go right here, at this point, what happens is now you have price that moves from here to here, and as a result of that, this area right here, all of this is the premium that people pay for having not enough supply. So when demand is greater than supply, you will pay a premium, which is what happened for the last 2 years. All right? Now, the question is it possible for prices to crash right now based on our current housing market? Okay, why is that it's not?
Because the demand's still pretty high.
Exactly. Okay, so right here you have a supply curve, right? So in economics we call it a shift when a curve shifts. You guys might be familiar with this. And so what happens is that when it shifts like this, then all of a sudden you have a new equilibrium that occurs and prices come back down. But in this particular case, supply is a non-event when it comes to housing. And the reason is that there are no substitutes for housing. So like, for instance, if I have a commodity like sugar, I can always get something that is a substitute for sugar, right? But when I want a house, the only substitute that there is for a house and all the building materials is from a 3D printer. They made the first house in New York. Okay? That's it. There's really nothing else. You can't get a substitute for cement. You can't get a substitute for wood. You can't get a substitute for hardly anything that goes into the house. So if I were to ask you a question, if I were to say, and by the way, this is a trick question. It's a great question. If I were to ask you how many suppliers does it take to make this pen, what would you say?
About 4.
About 4? Okay, what else?
There's many.
Okay, the answer is that it's infinite. And the reason it's infinite is because the extruder that makes the plastic has millions of parts to it. Where do those parts come from? Right? And so when we talk about the idea of demand that's happening right now, it goes throughout everywhere. It's very fluid. And so what happens is that because there are no substitutes for housing, and because we're not building enough houses to keep up with the creation of households, then you have a short of supply that is just, it's called, economists use a term when they call it outstripping. Where demand outstrips supply, where there's no chance that supply will ever catch up. And so as a result of that, you have this mix here of people that makes it really difficult for us to be able to keep prices down. Now, it's important to know that, and we'll read about this in a little bit in the material that I gave you, and we prepared this for you so you could share this with your clients. And there's a lot of material in here that you can give them and help them understand that we're not going into a crash. It's not going to happen because the supply is so restrained. Right now in Southern California, there was an estimate by Adam, it's a research institute, that Southern California on its own is down by 7 million houses. Now there's Freddie Mac out there, which came back and they said, well, we're down by 4 million across the nation, but that's just not, it can't be the case because there's been 13 million new households that have been established from 2012 to 2021 because millennials are getting older and they're establishing their own households. The problem is that there's only been about 5.8 to 6 million homes that have been created, right? And so there's this massive shortage. And so when we talk about prices going down, we talk about prices going down from the relative standpoint of where we're at. So from the last 12 months in the Canal Valley, prices have gone up 14.7%. Okay? So, and if we get to it, we'll read about this. And the way that economists look at it and they project what prices will be for homes, and this is a real telling, this is really important, is that for every interest rate that the rate goes up, prices will come down by about 4 to 6%. Okay, now remember, when we're saying prices 4 to 6%, that's from where we're at. So if we're at 14% and it's a 5% decrease, then we only have a 9% growth, only a 9% growth, right? And if we have another point up, then it goes down another 4%. Well, we're still positive. Prices are still rising. So even though rates are rising, prices can still rise, right? Okay, and right now, because we're coming off the bloom of the appreciation that's been going on with the market, the chances for the prices to plunge, especially in our area, is almost zero. Now, there's going to be definitely price reductions, but remember that in California, let me ask you this question. In California, what do you think was the equity that was built in 2021 on an average basis throughout the state? 90,000? What do you think? 65,000? 150. The answer is 110.
Wow.
So everybody got a gift of 110,000 by simply living in the state of California in their equity. And so when we talk about the bloom coming off and we talk about prices going down, we have to ask ourselves the question, well, what exactly does that mean? I mean, where are we at? I mean, what is the measure that we're trying to do? And the most important thing is that remember that a market price is based on what a willing seller and a willing buyer are willing to negotiate, not under duress, right? And so when that happens, what you have is you have a free-forming market, and that's why a lot of times the appraisals that come in don't validate what the market value is, because the market value is determined by the buyer and the seller, not by what comps are necessarily. Right? Okay, so this idea of prices plunging is way out of line, and in our area, the chances of it happening anytime in the future are really remote. Prices can go up another 2%, and what will be restrained by price is the ability for people to qualify, not necessarily by price. Now, price obviously will come down and it will moderate, but to suggest that there'll be a plunge or that people should wait because prices are going to go down, I would say we don't really have anything to back that up. Okay, I mean, there's not really a lot of, I can't give you economic data that will support that.
With regard to prices coming down, so I've been analyzing all of the price reductions. 90% of the price reductions were not priced correctly to begin with.
Correct. That's a big deal, Terry.
Look at what the market is right now.
Right.
And just added another 50,000 on top of it. And so when the media says all houses are coming down in value, prices are reducing, you really have to look to see if it's priced right to begin with.
Correct.
Now, I don't know if that'll adjust itself after a while, but right now, that's what's happening.
Right. Okay, good. Excellent. Very good. I appreciate that. Now, the other issue, okay, so did I explain this idea on the plunging prices? Does that make sense? Okay. All right, now let's just hit on a little bit of recession, and then I'm going to take you through just a little bit of these articles. Okay, so when we talk about recession, the question is, are we in a recession? So when your clients say, well, we're in a recession, I want to hold off on buying, does that make any difference on housing? It does make some difference, but it doesn't necessarily dictate what prices will be, right? And so the definition of a recession is negative growth for 2 quarters, but that's a general definition. It was 1.6 negative in the month of, in the last quarter, the first quarter of 2022. And they believe that it will be, and by the way, my wife's here. Hey, good to see you, Carol. Thanks for coming. Always appreciate the support. The figures for the second quarter have not come out yet, but the belief is we'll be about 2% negative growth. Now, when we talk about GDP in the United States, just kind of this is kind of an interesting aspect is that the United States is probably about 5% of the population of the world, but it produces about 25% of the GDP over the world overall. So it's a really big number that we have. And so when we're talking about negative growth, you have to really say, well, what is it that's negative? You know, what is it that's down? Because there's a lot of sectors that go up and down as well. So when we talk about recession, we're simply saying that there is growth that's been slowed because prices or because the cost of money, i.e. interest rates, have increased. Now, it's really interesting to note that people automatically think that when rates go up, when the Fed raises rates, which is the federal discount rate, they believe that the mortgage rates will go up. But right now, there's a disconnect on that. The reason why there's a disconnect is that we have a lot of geopolitical turmoil going on, and we have issues that are happening. So what's happening now is that as the rates go up, as the Fed increases the rates, we'll think they'll go up another 3/4 of a point, so the Fed rate will go to 2.5%. Well, when that happens, generally speaking, fixed rates go down because it calms the market. Fixed rates are on bonds that are on a 10-year or 30-year basis, whereas the federal funds rate are short-term funds that aren't always tracking what mortgage rates are. All right. So when we talk about recession, there are a couple things that are important to know about. I'll just kind of teach this to you a little bit in general, so you have a little bit of an idea. So there are different types of recessions. There's called a U-recession, and a U-recession means that economic activity falls, and usually there's a mirror between the two sides. So whatever happens on this side happens on the other side. So when you get into a U, it means that economic activity goes down, and it generally takes a long time for it to come back up. The best way to describe it is knowing you have to throw up, but you can't throw up. That's the only thing I can come up with, right? I mean, it just, and these last for an extended period of time. The last recession that we were in, it was for a long time because business was constrained. Then you have what's called the V. Now the V is a little bit different because when it goes down, the momentum increases as it's going down, and because it's reflected on the side, it means that there's enough momentum that when it hits bottom, it comes up and we come out of a recession. So a V recession is much quicker than a U. So our prognostic and the research that we're doing at Main Street is we really believe that we're in a V atmosphere. And the reason we are is because the Fed is not afraid to raise rates. So whenever they go up 3/4 of a point on each increase, it basically is a robust way of saying, okay, we want to slow economic activity. So we believe that the recession will be short. We do believe that there is a recession. We think that but it's a weird recession. It's weird because for every job that you have, for every job that's available, there's only half a person to fulfill it. That's what's going on. There are more jobs available than there are people to fill it. And quite frankly, we haven't had that kind of an atmosphere in any kind of a recession in the past. We've never been in a situation where we have more jobs than we have people to fill them, but yet we're slowing economic activity. So that's why the jury is still out as to whether or not we're really in a recession. There's a board that meets that decides whether or not we're in a recession. And right now, that board is saying, I don't know. They really don't know, simply because the dynamics in the market are so much different than most recessions that they've been before. Any comments or questions about that before we go on a little bit? Okay. Did I explain that okay?
Yes.
Okay. All right. Now go to, in the binder, if you go to housing market prediction, when will it crash? There's a couple things that we'll read here. And would anybody like to take a stab at reading the first paragraph? Fourth?
I'm happy to read.
Okay, go ahead. The one that's marked.
The first one in this article.
Yeah. Mm-hmm.
In this article, we
No. The second one where there's a little line. Yeah.
Okay.
Mm-hmm.
Is the U.S. housing market eventually going to crash? Despite the clear signs of a slowing market, it remains competitive for homebuyers, with new records set for home selling speeds and price increases. Home prices are rising due to a mismatch between supply and demand. But this is not a housing bubble. Many experts predicted that the pandemic would cause a housing crash on par with the Great Depression.
Okay, stop there. So when it talks about this mismatch, this is really a big deal. The reason why it's a big deal is because the pandemic caused supply chains and supply lines to be interrupted, right? So what happened is that within a nanosecond, literally a nanosecond, when everybody was said, okay, you got to go home, in March of 2020, our economy went from a service economy to more of a manufacturing economy. Because what happened is when people had to start staying at home, that's when they bought Pelotons, right? That's when they bought furniture. That's when they bought backyard equipment. That's when they bought playground equipment. They bought stuff that you had to make. And so when you have to start making stuff and there's an increase in that, then the manufacturers go to the raw suppliers to get that material. And so what they did was they ramped up, and they ramped up so much that in December of last year, November, December of last year, even October, there was a massive oversupply. And so you probably heard about all the specials going on and all the discounts that are going on, right? Well, it's because manufacturers ordered too much stuff. There was too much stuff that was made, which also is a part of the recession. So it's a weird way to look at it. That hasn't happened in the past, to where there's a mismatch between supply and demand, right? They were calling inflation more transitory. Well, it's not transitory because there was too much demand, and now the supply has dropped off. Okay, so go ahead. Who wants to read the next paragraph? We'll kind of go through this quickly here.
I'm happy to read.
Okay, go ahead.
That, however, is not going to happen. The market is in a far better shape today than it was a decade ago. The housing industry has had a boom last year, with the largest annual gain in single-family house values and rentals, historically low foreclosure rates, and the highest number of home sales in 15 years, reaching 6.9 million for the entire year.
Okay. All right, so a lot of people are in homes, right? This is good. All right, let's go ahead. Go ahead.
The national home prices have increased 33% over the previous 2 years.
Okay, now remember, when we track home price increases, Fannie Mae, or the HUD, Housing and Urban Development, they track bases on an index of 4% gain per year. Okay, this is 33%. This is on a national basis. This is unprecedented. Okay, this has never been the case. So people are thinking, because you've had such a big run up, is there a bubble? Right? Is the foundation going to cave in as a result of that? Okay, so let's go ahead.
The market was driven by record low borrowing rates in 2020 and 2021, and a constrained supply due to overbuilding.
Underbuilding.
The tremendous demand from first-time homeowners is almost as crucial as the restricted new supply.
Okay, so that's what we were talking about right here. We were talking about here that demand is outstripping supply because supply does not have a chance to catch up. That's what that means. Okay, go ahead.
The exceptionally favorable age demographic trends are also the driving force behind the current housing market.
Someone else want to give Tracy a relief here?
I can go.
Okay.
According to Freddie Mac, there are currently 18% more persons aged 25 to 34 than there were in 2006. This represents an increase of 6.6 million prospective first-time homeowners, from 39.5 million in 2006 to 46.1 million today. In addition to the increase in first-time homebuyers, the number of high-income renters who can afford to buy and are a prime first-time homebuyer age has also been growing.
Okay, so what's that tell you? There's an opportunity, right? A big opportunity for first-time homebuyers. And when I talk to a parent, when I talk to a boomer, I'm a boomer, when I talk to a boomer and I say, I'm in the mortgage business, you know, we transform lives through homeownership, things like that. The first thing they say is, how are my children ever going to be able to afford? And the words they use, which is really interesting to me, is they say they're never going to be able to buy a home in my area. My kids aren't going to be able to live by me. And that is just the biggest fallacy of the. I mean, it just doesn't happen. We have first-time home buyers that are buying their first home that's $1 million. That is not uncommon for this area. Both partners, whether they're married or not, they're both making $70,000 to $80,000 apiece. The credit's good. They qualify, right? It is for people to think that first-time home buyers can't buy in our area is a fallacy. It's so far from being correct. And that's where the education aspect of it is so important. And we'll talk about that just in a little bit. Okay, now go down to the next arrow, please.
In 2006, lending...
Right here?
Oh, you want
Right?
to do it?
Yeah.
No. The next arrow?
Yeah, I'll tell you what, go up to the one above it where it says the government and jumbo segments.
Okay, the government and jumbo segments had the most significant tightening in the previous month. These two housing markets couldn't be more different from one another. And the current situation is in no way comparable to that of the past. The Mortgage Credit Availability Index, MCAI, is an index that is released on a regular basis throughout the year by the Mortgage Bankers Association, MBA. This index is used to measure how simple it is to get a mortgage.
Okay, good. Okay, now go to the next.
The higher the index is, the more options there are for obtaining mortgage finance. In 2004, the index was hovering around the 400 mark. As the housing market heated up, the mortgage loans became more available, and then in 2006, the index surpassed 850. The Mortgage Credit Availability Index, MCAI, fell as a result of the fall in the real estate market since it became nearly hard to get mortgage financing.
Okay, good. All right, now who wants to read next?
I'll read next.
Okay.
Since then, thankfully, the conditions for lending have been relaxed a little bit. Although the index is still rather low, the index had a reading of 120 in May, which is around 1/7 of what had been in 2006. It remains more than 30% below pre-pandemic levels. Because there aren't as many options on the housing market, a lot of people in the United States are having a hard time finding the house of their dreams.
Okay. All right, good. All right, so there are some challenges, right? There are some definite challenges because we've seen a run up in price. But the question is, does that mean that people won't be able to buy a house? Okay, it certainly does not. Okay. Now, if you go to the next page over, where it says, there's a paragraph that says, finally, favorable demographics suggest.
Top of page 4.
Yeah, it's not numbered, but suggests that the robust demand for first-time homebuyers will persist. This is due to the fact that there are still a substantial number of younger renters with sufficient income to sustain home ownership, and they should continue to be a formidable force for the foreseeable future. As the economy faces various headwinds in the next months and years, these variables should continue to exert a substantial influence on the housing market. Okay, so there's the opportunity is there. The question is how do you hit in our market in Southern California? How do you hit the dry side of the spitball? Right? You can do it. It's out there, but it has to take a little bit of ingenuity to do that. Okay, now real quick, current state of mortgage lending. Right now, the availability of money is very high. The important thing is that when we get into self-employed individuals and we get into non-QM, has everybody heard the expression non-QM, where it's a non-qualified mortgage, right? That's a mortgage where it's not bought by Fannie Mae or Freddie Mac. It allows you to be able to determine income based on bank statements, things of that nature, right? Well, the non-QM market, selling these to the secondary market on Wall Street, has been in great turbulence. There have been 2 non-QM lenders that recently went bankrupt. And the reason is they didn't hedge their locks correctly. And so when the margin calls came for those hedges, they didn't have enough money to do it. And so as a result of that, they went out of business. So we have had some very interesting experiences lately with non-QM space. And when you get an offer from somebody who is writing a deal, and it's really important that you ask the question, is it conventional lending or is it a non-QM deal? It's really important because once you understand that, the dynamics of going with a non-QM lender, they're like cowboys. They're a lot different. And so it depends on who you're working with. It depends on their reputation. And our policy moving forward is we will double app with a lender if it's a non-QM deal. We will go to 2 lenders just to make sure that we're going to be covered. All right, so you want to really cover your bases to understand the buyer's capability. The pre-approval letter right now is okay. You know, we can get you a DU approval, we can do all that, but if it's a non-QM deal, if the applicant is self-employed and they cannot use regular tax returns, then you need to know that. Okay, and that needs to be communicated to the seller. It needs to be known, and really carefully make sure that the buyer and the lender of that buyer has it wired. Okay, did I explain that okay? I cannot overemphasize how important that is, right? I'm sure as escrow and title, you've run into some situations, right? What have you run into?
I have a non-QM where, lender who they were coming in and the rates got hiked up like maybe 3 weeks ago. And it was just a fire drill to get them all because they can't lock the rate. So they had 4 deals and said, we got to do this now. And it was just like full panic.
Right.
Closed all of them, but it was just oof.
Yeah. And so this lender that went bankrupt, all those lenders, all those loans that were in process were all canceled. So they had to go elsewhere to get those.
Wow.
Okay. So
These were the non-QM?
Non-QM. Now, the thing about it is non-QM is fantastic. There's no question. They will do stuff that, you'd never think that anybody else would do. But they still have to follow Dodd-Frank guidelines, which is the ability to pay. And that's ATP. If they have the ability to pay, they can prove that, but they can do that through bank statements. But the rates are much higher now, and so there's a lot going on. So if you've been working with buyers in that space, it's really important that you get them requalified again. And we'll be glad to do that for you to make sure they still qualify for the prices that they want. Okay. All right. Okay, any questions on that before we go on? Okay, all right. Okay, now why is waiting a bad argument? Well, let's say that you got a purchase price of $750,000. We got a loan amount of $600,000. The rate is at 4.375. Okay, that's lower than where the rates are now, but this will give you an idea. Well, let's say that you have a client that says, okay, I'm going to wait till the prices come down 50,000. Chances of coming down 50,000, if they were priced high to begin with, is a possibility, what Terry talked about, right? But, you know, okay, let's humor them and say, okay, that's fine. Well, in that case, your loan amount is $560. The interest rate is only 1% higher. Now, what's happened recently is what? Rates have gone up 2 to 3% higher than where they were, correct? Okay, so on a 30-year fix, the question is it better to take a lower rate, or is it better to take a lower price on the home? Well, the answer is it's a $90,000 difference by virtue of the higher rate. And it's also higher to qualify for. So when Greg talks about the aspect of being able to buy down your rate, that's a big deal, right? You could actually buy down the rate. We're in the process of working with a client right now that's buying down the rate from 6.5 to 4.75%. And the buy down is going to cost them $14,000 if they decide to do that. But you know, there are some concessions with it where they can do that. And so that is amazing because the affordability for them to qualify are huge to do that. So there's some really interesting things going on. Yes?
What are the down payments on those? Give or take, you know?
The down payment on this one,
20%.
well, it was 25% because it's going to be an investment property. But generally speaking, you can put down 3.5% to 5%, right? So at 5% down, at $851,000 loan amount gives you about a $900,000 purchase at a 5% down in Ventura, but in Ventura in Los Angeles County it's $970,000.
Oh, yeah, there it is.
Right? Yeah. So it's really,
Paying attention.
yeah, no, that's good. All right, so let's keep going. So the idea for people to wait is not a good idea because we don't know what's going to happen. If rates continue to increase, they will price themselves out of the market because they can no longer qualify. Not because prices have gone up, but because rates have gone up. So when somebody has a home and they're ready to go and they like it, man, it's a golden opportunity. You know, you don't want to pass up a home that you like and that you qualify for.
Yeah, I think on what you're sharing with that too, like with the buyers that are, you know, kind of dragging their feet a little bit, because if you take a look at the extra money that they're paying